Great. Well, thank you guys for joining us today. I'm Paul Martin. I'm the CEO and founder of 10 Capital, where we help startups and investors connect for funding. And today we have one of our Ask Me Anything webinars, which is going to focus on term sheets. If you have any questions as we go along, feel free to put those in the chat box or raise your hand and we'll answer them. And we'll usually have some time at the end as well. If we have too many questions, we'll be glad to follow up afterwards to answer your questions. So let's dive right into it. Term sheets. So not everybody is familiar with term sheets, and it's not often the most favorite topic that entrepreneurs and investors want to talk about. And so instead of going through all of the terms, we're just going to talk about some of the key deal structures and the key terms that you should look for in launching your startup and growing your business. There's over 125 terms in the National Venture Capital Association term sheets book, but I would say there's probably about 10 to 15 of those that are actually used and are important to know right out of the gate. The rest you can look up as you go forward. So the first is type of security. When you are looking at term sheets, there's three basic kinds of securities you'll see in this startup world. The first is an equity agreement, and these are often called preferred stock or Series C preferred stock or what have you. And the second is what's called a convertible note, which is a debt instrument that converts to equity later. And the third kind is a safe note, which is essentially a warrant. It gives you the right to buy stock later at a certain price. And so we're going to talk about those later as we go forward. The next thing you want to look for in a term sheet is the investment amount. How much is being raised? You need to know what that number is. And because of the third term to look for is what's called the pre-money valuation. This is what the business is worth before the investment goes in. And if you take the pre-money valuation and you add it to the investment, you can arrive at what's called the post-money valuation. And as an investor, if you want to know what your ownership stake is, it's the investment divided by post-money valuation. So it's a key thing to understand what's going on. As you'll see here as we go forward, valuation is probably the most important term to understand and negotiate in a term sheet. The rest are important too, but nothing has the impact that the valuation has on your final return. The next thing to look for is many times you'll see the price per share in the term sheet, especially equity term sheets. And the price per share is calculated by dividing the pre-money valuation by the total number of shares outstanding in the startup. And the share price is calculated where the term fully diluted shares outstanding comes into play. And so what you want to do is, fully diluted basically means we're going to count any form of equity that's out there, such as warrants or options pools or anything else. And if all of those are exercised, what would be your final ownership stake in that case? The next is conversion. And this is for equity term sheet. Conversion refers to the rate preferred shares can be converted to common. In the convertible note, conversion refers to converting from debt to equity. And we'll talk about that here in a little bit. And finally, there's dividends. And this is often confusing because in most cases, dividends are accumulating. You're not actually paying them out every quarter, every year. These are startups. They don't have cash to pay it out, but they are accumulating it. And that's part of the final equity payout that goes to the investor. So if we go to the next slide, one of the key concepts to bring to a term sheet is this a founder-friendly term sheet or is this an investor-friendly term sheet? And you want to look for certain key things to tell you which one you're looking at because that tells you from which position you are negotiating. So if you're an investor, you can actually organize an investor-friendly term sheet as an initial offer and then negotiate from there. So for a founder-friendly term sheet, the elements that you would see is number one, there is no expiration date on the investment offer. This offer you can put out there at any time and you can close it whenever you want in that case. The next one is the option pool. It comes out of both the investor's portion and the founder's portion. In an investor-friendly term sheet, the option pool comes out of the founder's portion only. In a founder-friendly term sheet, there's no confidentiality agreement, and founders are free to talk about the deal with anybody they like. In an investor-friendly term sheet, there's typically confidentiality and the terms and the negotiations are kept under that, and you're not free to talk about it. In a founder-friendly term sheet, there's no liquidation preference for investors. That means at the end, everyone just divides the proceeds pro rata. In an investor-friendly term sheet, you often see liquidation preferences come up, which means the investors get perhaps 1, 2, or 3 times their initial investment back first before everyone else gets paid out. And the last one is, in a founder-friendly term sheet, the startup usually doesn't have to pay the investors legal fees. In an investor-friendly term sheet, you'll often see that the startup is paying for the investor's legal fees itself. So those are some of the key things to look for in these term sheets to know which one you are looking at and how you want to approach it. So how you structure these is very good for helping you figure out where to go from here. So the next one is negotiations. There are some key elements that you want to negotiate in these term sheets. The first, as I said before, the first one is valuation. What is the equity ownership that the company is going to give to the investors for their money? And so fundamentally, the entrepreneur is pushing the valuation up and the investor is pushing the valuation down. Valuation, while there are many calculators and formulas out there, fundamentally it's not a formula, it's not a calculation, it's a negotiation. And know that when you go in. And you want to know that get as many points on your side to make the claim that you are worth the valuation that you say you are, while the investor is looking to try to understand what is really in the deal today, not tomorrow, and make the negotiation that way. As an investor, I often see startups that are using tomorrow's valuation today. One day I'll be, have $1 million of revenue, therefore I'm worth $20 million of valuation today. Well, note your valuation today is what's based on what's in the business today. Your valuation tomorrow is what's based on the business tomorrow itself. The next one is liquidation preference. Sometimes the valuation may not meet what the investor expects. And one way to close the gap is to sorry about that. I had to get muted there. So the next step is liquidation preference says the investor gets a portion of their investment back first. Sometimes it's 1 times your investment, sometimes it's 2 times your investment from any proceeds, and then the remaining proceeds are distributed pro rata. And that can be used to offset a very high valuation. So if I'm an investor in your deal and I don't think you're worth the valuation that you say it is, maybe I put a 1 or 2x liquidation preference, and that evens things out in that case. The next step is investing founders' shares. So when investors come into these deals, what they want to know is that there's someone in place with the stock that they're giving them to achieve the goal. These are often 3, 4, 5-year goals. And so what happens if the CEO leaves early? If they have taken all of their shares and they leave a year before they are supposed to finish, what is there to replace them when they go? And so what you'll see many investors do is invest founders' shares in order to keep shares available in case there's an early exit by the CEO for whatever reason as well. And the last one is redemption rights. And this is the right to buy out early or sell your stake before the actual exit comes. And these are often negotiated by investors who want to make sure that their position is covered and that they have a way out of the deal if it goes beyond what was originally expected as well. So let's go to the next slide. And so here's a very important topic if you're raising funding now, because we often coach startups to use convertible notes to kick off their fundraise. And the beauty of this is that startups can start to accept investors into the deal with relative ease. The note is a rolling close. The investor signs a check, the CEO signs the note, the money goes into the business the next day. There's no escrows. And you can use the note over several smaller raises. You can come up with, say, a 500K convertible note, go raise 200K on it, decide that's enough for now, put it in the drawer, go work on the business for 6 months, decide you need more money, 6 months later, pull the note back out and just continue to raise on it. It's usually, most convertible notes are pretty simple, 2, 3, 4-page operations. And so you don't necessarily have to have legal experience behind that. We always recommend having legal experience, and in particular on equity agreements, you must have legal backup on it. But for convertible notes, they're pretty simple to do. And then the next one is you need to make sure that you don't raise too much on convertible notes. When you get to a Series A and you're trying to raise from venture capital or other groups, they're going to expect a certain amount of ownership for that. And if you've used the convertible note for too many years too often, you may find that there's not enough room left for the venture capital investor who has specific criteria. They need to have at least 20% ownership to make it worth their while, and it may kill the deal. So don't treat the convertible note like a credit card that you don't have to pay off for several years, because you can raise too much on it, and then it's difficult to make it go forward from there. Let's go to the next slide. So the pros for the convertible note is that, it's very well set for seed rounds and bridge rounds. Even after Series A or Series B, when people are going out for the next round, they start with the convertible note to capture initial interest into the deal while they're looking for the lead investor. You just don't know when the lead investor is going to come in. In the early stages, my rule is that you're looking for an investor that will put in at least $100,000, and they really want equity. And with that level of investment commitment and that interest in equity, they'll be a great lead investor to go set the valuation, set the terms, and do a proper job. That's because follow-on investors are going to come back and look at that to see how well that was done. Do the numbers make sense? If people do this correctly? And so you don't want a 25K check writer, negotiating the valuation, because it won't hold up later. The next thing that you like about convertible notes is that it's lower in cost compared to equity term sheets, because the documentations are just much simpler. There's not boards or option pools. None of that's being done at this stage, and so it's easy to get up and running. The third thing that's very important is that it doesn't set a price, or it doesn't set the valuation for the company. And in the very, very early stage, setting the valuation can be very tricky, and it can be hard because there's not enough there to really set the valuation. If you wait 6 months or 12 months or more, there'll be more of a business there, and it will be easier to set that valuation. And then make sure it keeps the cap table simple, as they are in debt form and they convert to equity later. So it's not hard to work with convertible notes. There are some drawbacks, though. If we go to the next slide. Number one is there's very few protective provisions in equity terms in convertible notes that you normally find in equity term sheet. Like I said before, there's no board, there's no voting rights, none of that's there, and so you don't get that level of protection. Number two, valuation is not fixed, and later it will be set by the follow-on price round in many cases, and there's very little control the investor has over that. And then number three, there are no tax benefits. If you're looking as an investor at qualified small business 1202 and other tax benefits, what you'll find is that they only apply to equity investments, not to convertible notes. And so you have to think about that as well. So let's go to the next slide. And so that's a summary of what we're doing about term sheets. The one thing I'd like to add is that there's also safe notes. We have a lot of people coming to us with a safe note that it's a great tool to use. It's like a convertible note in that it's very simple. There's typically not any legal work that goes behind it. And I'm often asked by entrepreneurs, do investors sign safe notes? And my answer is, as long as there's a valuation cap on it, investors will sign a safe note. It's actually a warrant. It gives the holder the right to buy stock at a future time for a future price. And so it's a very simple way to get out of it. There's no interest rate, or there's no discount rate like on a convertible note. But what I found is, if you ever do the math in a convertible note, what you'll find is that almost all the valuation that comes out of a convertible note is in the cap rate. The impact of the discount rate and the interest rate is very, very, very minimal. And so when you talk to investors, you'll find that as long as your terms are all kind of in there with everybody else on a convertible note, they'll sign the note. They either want to be in the deal or they don't. And a safe note is simply a warrant that converts later, but it too does not have all of the protective provisions of a full equity agreement, but it can be a great way to kick off your startup raise and get things going. So first question up, if you have questions, go and put them in the chat box, and we'll spend a few minutes here with it, is how do you figure out your business valuation? Well, so number one, there's a number of calculators on the web out there. There's about a dozen, and you go out, put in your terms, and you can get what the business valuation is. There's one on the 10 Capital side if you want to try it out. I'd love to get your feedback on that. It's on the education page of 10capital.group. The next way is to look at what are called comps, and that stands for comparables. And so you look for similar businesses and you find out what their valuation was for either when they sold the business or when they raised money, and see what the going rate is. This goes up and down basically with the stock market. When the stock market's going well, valuations go up. The stock market crashes, valuations come back down. And so you're basically looking at what businesses are sold for and working your way back to what people will pay for those businesses up front. The other thing you want to think about is what impacts valuation is not only the current market climate, it's also what's in the business. I find, investors, for the most part, they want platform-based businesses, they want recurring revenue, they want an experienced team, and the more you have of those elements in your deal, the more they will value it, the higher valuation they will give. Again, another calculator on the 10 Capital side if you want to try it out, but think of those two terms. What's in the business today, not tomorrow, but what's there now, and then what is the current market rate for this kind of business? That's what drives the valuation as well. My basic rule of thumb is I have what's called the rule of 4, and it basically says for a startup, you want to give yourself $1 million for each of 4 things: sales, team, product, and intellectual property. If those 4 things are all fully installed in the business, then you can give yourself $1 million for each and add them up, and that gives you a $4 million valuation. If, for example, the product is not fully installed, but it's maybe in beta mode, maybe you give yourself $500,000 for the product. And so therefore, in that case, if the other 3 are fully installed, you would get a $3.5 million valuation. The key with valuation is when you talk to investors, it's not just a number, it's really a negotiation. And what the investor wants to know is, can you articulate all the values in the business and what each of those values is worth in a dollar? And if you can do that with the rule of 4, go through and think through what's in the business today and make clear what those elements are, that's what you want to take to a negotiation with an investor. You don't want to go in and basically say, I calculated what I want at the end of this process, so therefore my company must be worth $25 million. That will be tough to sell to an investor. So the next question is, which is more attractive to investors, convertible notes or safe notes? For experienced investors, those who've been around for quite some time, they tend to slant toward convertible notes because they're familiar with them. They've been around a long time, they've been tried and tested, and so they like it. For some investors, they like safe notes because it's simpler and so forth, but there's many varieties of safe notes. Some have interest rates, some don't, some have discount rates, some don't, some have valuation caps, some don't. And so there's many different flavors of them. And so I find investors are always digging through trying to figure out which one is this. So in general, I go with the convertible note because it just goes to a larger group of people. They like it. I also like the fact that there's a debt component to that up front as an investor. There's a lot of advantages with that. And so I go with convertible note. But I see as many safe notes out there today as I see convertible notes. And for the most part, investors at the very, very early stage really know they can't control valuation and the board and those type of things, and they just want to be in the deal. And so that's how they do that. So the next question is, at what point in the negotiation do investors need to see the term sheet? Well, I think what the investor needs to see up front is what are some of the key terms. This is a convertible note. We're raising $500K. It's got a 15% discount rate. It's got a 5% interest rate, and the valuation cap is going to be $5 million. So as long as you have that in mind, that's all you really need to show them. When an investor goes into due diligence, one of the first questions they'll ask is, what exactly will I be signing? And that's when they need to see the term sheet. So you can kick off your raise with those particular details. In equity, you can say it's an equity agreement. The valuation cap rate is going to be $5 million, and it's got a 1x liquidation preference. So you just pull out a few key terms. So at a high level, the investor knows what the deal structure is and where the valuation may be sitting. But when they go into diligence, then at that point you need to have the term sheet for them to read and set up. There's many sites out there. The MVCA has a great model legal documents site as well. For Safe Notes, Y Combinator has a great site for these as well. So you go out and you can pull down some standardized term sheets to begin your process. Again, with Convertible Note and Safe Note, I'm comfortable with using those tools off the web and customizing myself. When I go to equity, I get an attorney for that. So what time of year is the best to start a raise? Well, there's 3 cycles in a year. There's the spring cycle, there's the winter cycle, and then there's the summer cycle. And so what you'll find is that in January, a whole bunch of people line up and they start their raise and they go from January to May. And then I find a number of people come in April and May, and they're raising from April to September. And then I find people coming in August, September, and they're raising from August to basically the second week of December. So those are the 3 cycles we see come in every year for raising funding. If you have a good network, you can go out at almost any time. You will find it hard on the week of September, Christmas in December, and the July 4th holiday week. Those are basically dead weeks, but every other week in the year, we find people are engaging deal flow and doing work for their deal. So one more question here. Can you tell us what your funding as a service program is? So funding as a service basically says for the investor, we're providing the basic tools you need to go do deal flow, diligence, and find a right startup, but we're not promoting the deal to you or suggesting that's a great deal. We're just saying, here's a deal, and we're providing all the tools you need in order to make a decision. And then for the startup, funding as a service is helping people with getting their deal out in front of investors. It's basically investor relations, and it's providing the ability to help pull all your documents together into a data room, or what they call a due diligence box, and then helping you get a term sheet and coaching you on the process itself. So it's not a broker. We're not raising funding for you. Funding as a service is simply all the tools that you need to go out and run a campaign to raise funding yourself. And we believe the best thing to do is to go raise the money yourself, because engaging investors is a skill you should have. It's communication skills, it's follow-up skills, it's education. It's all the things that you need in order to be successful startup business person. And just like you need to hire people and you need to build products, so you need to be able to raise funding, and it's a skill you should develop. But we're helping you with the hard parts of that, is what it is. So the next question is what provisions of a term sheet are usually binding? Are there any hazards in an entrepreneur soliciting multiple investors for term sheets? So the answer is, if you sign a no shop clause, that is binding. If you sign an equity term sheet that with a certain valuation on it, that is binding as well. Typically, some investors will come in and they'll want some time to do due diligence, and they'll have you sign a no shop clause. So they have 30, 45 days to go look at it, do their diligence, and then make a decision to invest or not invest. And you have to look hard at that to see if you want to take your deal off the market for that much time for someone to do it. You know, if it's the right investor, if you think that's going to be the one you've always wanted, well, then it's worth doing it. If it's somebody you don't know and you're not quite sure, then it's probably not worth doing in that case. And so when you work with startups out there, the question is, are there any hazards in an entrepreneur soliciting multiple investors for term sheets? I don't think there's a hazard with that. I think you have to get out there and start talking to people. And what I recommend doing is bring your own convertible note to the table. If they want to be in the deal, they sign it, that's great. If they have their own term sheet, you get a copy of that and you start to review that. And you start to see what they're offering, and you're looking at what value they bring to the table in return for what price they're asking in the term sheet itself. And so you have to look hard at, is that a good deal itself? So I don't see any hazards in soliciting those. The magic comes in actually evaluating those and making a decision on one or the other. In the venture capital world, you have to be careful. Everybody talks to each other and they share deals with each other. So what you tell one investor, often that gets passed around to other investors. So at this point, I'd love for you guys to take a quick poll and give us some feedback if you'd like to learn more about what we're doing. If you have questions we did not answer, please let me know. Drop us a note and we'll put that, give you a follow-up email or call and help you figure that out. We do help startups with their term sheets. We have sample safety notes, convertible notes, et cetera, that we help people with and walk them through how it works. We have how a convertible note works that you can provide to some of your investors in case they want to sit down and figure that out on their own as well. And so happy to work with you guys on these things. If you have specific questions about your term sheets or a fundraise where you can let you do that, we can help you with that as well. Are there any other questions at this point? So if we give people just a minute more to see if they have a question to pop into the chat box. If you want to learn more about fundraising, we have a podcast program. The website's investorconnect.org. And on there, for those who are learning about these topics, we're actually running a series now on term sheets in what we call the Startup Funding Espresso. These are 1 to 2 minute podcasts that come out every day, Monday through Friday, 6 a.m. You'll get an email to your inbox with the transcription of it. And you can either read it or hit the button and listen to it. It only takes 1 or 2 minutes. But if you want to learn about funding, both on term sheets and other aspects of it and fundraising, the Startup Funding Espresso covers every topic there is. It will take a while to go through all of them, but if you're wanting to learn, it's a great place to start. So head over to investorconnect.org to get that information. Well, I don't see any more questions in. I think we're at the end of our time. I want to thank you guys for joining today and looking forward to hearing back from you on your term sheets and questions. And if you need help raising funding, let us know and we'll close it out from there. Have a good one.